So now it's time to introduce you to the statement of cash flow, and in so doing, we're actually going to construct the statement of cash flow for the winter quarter. In order to do that, we have to identify the cash inflows and outflows arising from what three activities? We presented this information to you earlier. It's the operating activity, and the information with which to construct the statement of cash flow from the operating portion will come from two financial statements, the P&L and the balance sheet. Investing activity, which will come from the balance sheet, and financing activity, which will also come from the balance sheet. So in order to do this, we need to assemble two documents. We need the opening day balance sheet, and we need the balance sheet and the statement of income for the first quarter. So the opening and closing balance sheet and the statement of income, which is a summary of those two time periods between them. And incidentally, we're going to use the indirect approach, which is to directly take the various accounts from the financial statements versus what's called the direct approach, which is taking the data from the actual general ledger for each of the accounts that comprise the statement of income and the balance sheet. The indirect approach is much easier, and we don't have access to the other accounts in order to do so. So we want you to refer to the statement of cash flow form now, and we'll construct the statement of cash flow for the winter quarter. As you can see, the statement of cash flow is divided into three areas: the operating area, the investing area, and the financing area. The operating area contains accounts that will come from both the statement of income, or the P&L, and the balance sheet. The accounts that we have listed here are not meant to be inclusive of all of the accounts in any of the three areas, but are directly related to the operation of our place. At our place, we have the net income after tax, the depreciation, and the amortization. They will all come from the statement of income, which is why there's no provision for a beginning period balance for those three accounts. Income statement values are all reset to zero at the end of any accounting cycle. And on the next day of business, they begin to increment as revenues and expenses are added to those accounts. So there are only ending values associated with the statement of income. The balance sheet accounts at our place, however, that will have an impact on cash flow from operating activity are balance sheet accounts. And they are accounts receivable, inventory, and accounts payable. In an ongoing actual business enterprise, there may be additional balance sheet accounts that would fit into the operating account activity. Prepaid expenses would be an example of one of those. We'll begin the indirect approach by entering the net income after tax for the first period, which is negative $9,807. Now recall that profits don't equal cash, but the indirect approach begins with the net income, whether it's positive or negative, and we add to that net income the other account activity that will either increase or decrease the amount of cash that's available to the operation. So we'll continue with depreciation. As I enter the depreciation amount of $6,750, notice how the total operating cash flow changes, which right now, with only the addition of the negative $9,807 profit, is a negative operating cash flow of the same amount. But depreciation is a non-cash expense, and we have to add the $6,750 non-cash expense back to that negative net income. So note that the total operating cash flow has gone from negative $9,807 to negative $3,057. Amortization, the amount is $2,500, also a non-cash expense. And with the addition of those two accounts, non-cash expenses, our total operating cash flow is now reduced to negative $557. Now, accounts receivables. On opening day, we had a zero balance in accounts receivables. At the end of the quarter, you'll note that we have an accounts receivable balance of $10,423. Before I make this entry, we need to understand, from a cash flow perspective, how the cash flow is affected when changes occur to asset and liability accounts, because we're moving now from statement of income to the balance sheet values. So it's important that we remember some fundamentals of cash flow. So we have a little review at the bottom of our cash flow document. A cash inflow occurs when an asset account decreases in value, or when a liability account increases in value. All right? Now, accounts receivable. Is it an asset account or a liability account? What does accounts receivable represent? Well, it represents money that people owe us. So if the accounts receivable balance increases over the course of a financial period, people owe us more money than they did at the beginning of the period. More sales were generated during the quarter for which we did not enjoy the receipt of cash. So, when an asset account increases, it's going to represent a cash outflow. So we have to be very deliberate when constructing the statement of cash flow. We have to make sure that we perform the mathematical part of the equation correctly, the difference between the beginning and the ending account value, but we also have to be sure that we put the right sign on that, meaning was it a cash inflow or a cash outflow? For example, the accounts receivable ending balance $10,423. We know the dollar change is going to be $10,423, but it's important to recognize that it's going to represent a cash outflow because accounts receivable is an asset account. When an asset account increases in value, it represents a cash outflow, and notice that it's recorded as a negative or a reduction to cash on our statement of cash flow form. Prior to that entry, you may recall that our total operating cash flow was negative $557, but the addition of this entry has increased that to negative $10,980. Inventory. We began our opening day with inventory of $24,800, and over the course of the period, we purchased additional food and beverages from our vendors that went into inventory that we used for production and sale to guests to generate revenue. So inventory is a constantly dynamic and turning account, as are the receivables and the accounts payables. So the inventory declined in value over the course of the period. Its ending balance is $9,390. We have to determine, is it an asset or liability account? Inventory is an asset. It declined in value over the course of the period. So the dollar amount of that change is going to represent a cash inflow. The difference is $15,410. It's an asset account. It decreased in value over the course of the period. So it represents a cash inflow. $15,410, and our total operating cash flow at this point is a positive $4,430. The final entry at our place to calculate the total operating cash flow is in the area of the accounts payable. Accounts payable is a liability, and you may recall that on opening day, between the vendor account payable of $24,800 and the smallware equipment purchase that we made on credit of $9,200, we began the period with $34,000 in an accounts payable balance. During the course of the period, we made additional purchases on credit. It's a dynamic account. It's going to be changing, as do the accounts receivables and the inventories. And at the end of the period, its balance was $6,573. Accounts payable is a liability account. Again, think about the effect on cash. We owe people less money at the end of the quarter than we did at the beginning of the quarter. The only way that could occur is by paying those people over the course of the quarter. So the change in this account is going to represent a cash outflow of $27,427. And the total operating cash flow at our place in the first quarter is not very good. It's a negative $22,997. Remember the equation for survival in business. Survival in business is a cash flow greater than or equal to 0. So unless some things occur in other areas of our statement of cash flow, our place could have a very short life expectancy of 1 quarter if we fail to make good the promises.